Hi, I'm Michael Yardney, and last week I wrote an article and did a video about 3 surefire ways of losing money in property, and it must have struck a chord as tens of thousands of investors read it, they watched the video, and they emailed me some further questions. This got me to thinking about other ways I've seen investors get it wrong. You see, the unfortunate truth is that most investors fail to reach their objective of financial independence. Statistics show that half of those who get involved in property investment sell up in the first 5 years or so. And you've probably read that those who remain in the game, less than 10% own more than 2 properties. I've often said property investment is simple, but it's not easy. Now, that's not a play on words. What it means is that there are proven systems and strategies that have helped create wealth, and many Australians have created wealth through property. However, too many investors do the wrong thing or get swayed by promises of overnight success by those messages we all kept getting in our inbox. Now, last week I suggested you avoid buying off-the-plan properties or new homes in those new estates, the new outer suburban estates, or trying to buy property with options, which are really just smoke and mirror games. Now, let's look at another 7 ways you could lose money in property if you're not careful. The first one is not to have a strategy or a plan. You see, I found most Australians spend more time planning their holidays than they do planning their financial future. The problem is that if you don't have a strategy, it's easy to get distracted by all those so-called opportunities that keep cropping up, many of which don't work out as expected. Just look at those investors who bought off-the-plan properties or in what they hoped would be the next hotspot or in mining towns, only to see the value of their properties underperform. My recommended strategy for financial independence is to build a substantial asset base over a 10 or 15 year period by purchasing high growth properties and then adding value to them through renovations or redevelopment. Then over the next years you keep adding more properties to your portfolio as your cash flow and your equity position allows. Then in time you slowly lower your loan to value ratios and start living off the equity of your property portfolio. The next mistake is not reviewing your property portfolio. Property investment's not a set and forget affair. To be successful, you must treat your property investments like a business and regularly review their performance. Look, of course you can't easily or cheaply swap properties or reweight your property portfolio like you could with shares. But that doesn't mean you shouldn't regularly review your portfolio to see what you can do. Well, you may be able to improve or upgrade your properties. When was the last time you checked to make sure you were getting the best rents? Or that your mortgage was appropriate for the current times? Maybe it's time to refinance against the increasing equity of your property and you could use the funds to buy further properties. Or if you can't afford to buy more, maybe you're just going to top up those financial buffers that you've set aside for a rainy day. To get financial independence, it's important to own the right type of properties that allow you to take advantage of this new property cycle, because over the next few years, some properties are going to strongly outperform others. That means that if you own secondary properties or real estate in areas that are unlikely to benefit from strong capital growth, it may be worth considering selling and then replacing them with a type of property that will help you develop long-term financial independence. The third way some people are going to lose money over the next little while is not managing their risks. Many investors don't understand the risks associated with property investment and therefore don't manage them correctly. Smart investors don't just buy property, they buy time by having sufficient financial buffers in their line of credit or in their offset accounts, not only to cover their negative gearing, but to see them through the ups and downs of the property cycle. Another way sophisticated investors protect their assets is to buy them in the correct ownership structures, those structures that could legally minimise their tax and protect their assets. I found that most wealthy people own nothing or very little in their own names, but control their assets through companies and trusts. And of course, you must protect yourself by having adequate income protection and life insurance. Another way people are going to lose money is by thinking they can do it all on their own. You see, the property market is booming in many of our capital cities, and so some investors suddenly think they can buy almost any property and it's going to be a great investment. Unfortunately, this is far from the truth. In my opinion, less than 5% of properties on the market are what I'd call investment grade. And just like in the last cycle, many investors are going to lose out. Don't be afraid to ask for help, but make sure it's from an advisor who has your best interests at heart and is paid by you, not by a salesman whose loyalties lie with his clients, the vendor or the developer. Buying property is a complex process, and if you're the smartest person in your team, you're in trouble. Now, of course, I think a property investment strategist should be at the centre of your team, coordinating all those around you. But then, some would say I'm biased. However, I know that my team at Metropole Property Strategists has helped thousands of ordinary Australians create significant wealth through property over the years. The fifth way you can lose out in the future would be by believing a lot of those get-rich-quick schemes that say it's easy to become a multimillionaire overnight through real estate. I've found some investors just trying to find that one big deal that's going to get them rich overnight. Others try to make money by trading properties. Unfortunately, the buy, renovate and sell strategy that you learn from TV programs like The Block just doesn't work in real life when you've actually got to pay the tradesman and you've got to pay interest and you've got to pay tax. Remember Warren Buffett's great quote, "Wealth is the transfer of money from the impatient to the patient." The next way you could make a mistake is not doing sufficient due diligence and groundwork. Because even though some of our capital city property markets are booming, that doesn't mean you can just buy any property or pay any price. This year, the market won't cover up those type of mistakes. This means not doing your homework can cost you lots of money. So can falling in love with a property for all the wrong reasons. As an investor, the only good reason for falling in love with a property are that the numbers stack up, or that it fits your plan, or the property has more upside potential than the issues that it's got. And it of course helps you meet your goals. Don't let emotions drive your decisions. That's what home buyers do, not sophisticated real estate investors. And the other big mistake, the seventh one, is buying the wrong property. Of course, all properties are going to increase in value over time, or almost all will, but some are going to rise significantly more than others. To help build financial freedom, you're going to have to own the right properties, one that's going to grow sufficiently to enable you to borrow against this increased equity to fund the purchase of further properties. However, when you ask investors why they purchased their property, they say things like, "Oh, it was close to where I live," or close to where they want to holiday, or close to where they want to retire. These are all emotional reasons for buying property. And that's why, I guess that's why, how a lot of people buy their homes, but it's not the right way to buy investment properties. Instead, I suggest you use my 4-stranded strategic approach to selecting a top performing investment property. Number one, I buy a property below its intrinsic value. That's why I avoid those new properties and off the plan properties which come at a premium price. Then I buy a property in an area that's had a long history of strong capital growth, and one that's going to continue to outperform the averages because of the demographics in the area. This will be an area where there are more owner-occupiers wanting to live there because of lifestyle choices, and it's an area where the locals can afford to and will be prepared to pay a premium price to live there. I also look for a property with a twist, something unique, something special, something different, something scarce about the property. And finally, I look for a property where I can manufacture some capital growth, through renovations, refurbishment, redevelopment. To help make 2014 your best year ever in property, I suggest you become financially fluent by learning from others' mistakes rather than from your own. I'm going to give you insights into how to take advantage of the opportunities 2004 is laying in front of us, and more importantly, what you should do and I guess what you shouldn't do in a series of one-day trainings I'm conducting around Australia in March and April. Please click the link on this page and get all the details of my national property market and economic updates. Then reserve your seat, and I'd love you to come and join me. I look forward to seeing you there.